On today's show, Nvidia leads the market lower, Chinese stocks rally, are stocks overvalued, and should you buy this dip? We've got a lot to talk about. Roll the tape. Welcome everybody to the Daily Recap Show where we talk about stocks and the financial markets. My name is Chase. If you like this video, please subscribe, hit that notification bell as well as the like button, and leave a comment for the algorithm. Let's get into it. This is the daily heat map of the S&P 500, and US stocks pulled back on Monday as Nvidia shares slipped amid a Chinese antitrust probe, and investors prepared for the week's consumer inflation report. And we saw some very mixed price action. If we just take a look at the communication services subsector right here, we can then look at everything, right? For example, telecom services fell in a very big way. That was on the back of some news we got here from Comcast, but we did see Verizon gain. Then you look at entertainment, they fell because software was down very, very big. And then you actually have a look at Google, which was flat, Meta, which was down big. So very mixed price action across the board. All in all, red nonetheless. We saw the same here in technology. Apple and Microsoft were up, but the broader infrastructure and semiconductors were down big, particularly Nvidia, as we start to see the early innings of a US-China trade war. Financials were down in a very big way, except for PayPal, up 0.84%. And then we did see some green in the market here in healthcare, energy, real estate. That was really what made the market here today. Looking at the sector analysis, the SPY was actually down 0.51%. Pretty ugly day, but in the context of everything, not that big of a deal, especially when you look at the year-to-date chart. The green sectors, like I mentioned before, healthcare, energy, materials, real estate, and then the sectors that actually lost, communication services, financial utilities, technology, industrials. So all in all, guys, what we really saw was just cyclical sectors underperform. We saw stuff like materials, energy, real estate, healthcare, somewhat defensive sectors, commodity-driven sectors really outperform here today. But all in all, when you have these bigger names, the tech names, all you're really going to see the market take losses. And that's why we saw the S&P 500 down, as well as the Nasdaq and the Dow Jones. And this sums it up very, very well. Large cap growth, mid cap growth, two of the largest sectors in this market right here fell down 1.85%, 1.29% respectively. Large cap core also fell. So too did large cap value. When the large cap space falls, you're really going to get a pullback in the market. Same here with the mid cap space. It was red across the board. The only green sector was actually small cap value, up 0.13%. And that contains a lot of like these energy names, biotech names, healthcare names. They're in that space. And as you can see, we sort of had energy, materials, and healthcare outperform here today. But all in all, guys, it was a very red day in the US, but not globally. We actually saw some very upbeat action here in China and Europe on the back of stimulus and monetary easing coming their way. As a result, Europe followed suit. We saw some upbeat action in South America. North America was very red, and then Australasia pretty green as well on the back of that Chinese news. And China stocks, especially US listed Chinese stocks, topped on Monday, defying broader market trends after Beijing promised bold measures to loosen its monetary policy ahead of the risk of tariffs and trade tensions stemming from an incoming Trump administration. Shares of Alibaba, Xpeng all jumped today following the lead in Hong Kong. China's top leaders vowed for proactive fiscal policy to shore up the Chinese economy. The Nasdaq Golden Dragon China Index jumped more than 9%. Very strong move here in China stocks. We'll see if this actually can keep up the momentum, but nonetheless, you can't deny the strength by seeing the market definitely likes what Chinese officials are spouting. Now, on the back of that, China also launched a probe into Nvidia, and that's why Nvidia was down 2.79%, and that really led the broader market to sell off, particularly in early morning trade. Chinese regulators opened a probe into the chipmaker for potential breaches of anti-monopoly laws, and as Trump's rhetoric comes into full view, countries like China are going to start taking proactive measures to protect their economy, and that really starts with attacking the US companies, and one of them is Nvidia in the crosshairs, and we're going to see much more of the same. And this is exactly what we saw in the beginning of the US-China trade war. The US is going to take shots, China is going to take shots, but it seems China's been a bit proactive and even putting in measures before Donald Trump is in place. This is all speculation. at this point. This could literally be Nvidia actually breaching anti-monopoly laws. We don't know. We'll see what to come from this. But based on all of the antitrust news we've seen, especially with Google lately, the market definitely sold off. All in all, despite all of the price action we saw today, we actually did see a recovery in the stocks above their certain moving averages. Now we saw here, look at the 5-day moving average. We did see a pretty big recovery. Look at the 20-day, a recovery there as well. Look at the 100-day, a mild recovery from Friday into today. So despite the red day, we did see market breadth improve, and we also did get some very positive news in terms of S&P 500 price targets. Oppenheimer's chief investment strategist John Stoltzfus initiated a year-end 2025 S&P 500 target of 7,100 in a note to clients on Sunday, marking his highest projection among strategists tracked by Yahoo Finance. The target represents roughly 17% upside from where we closed today. The 7,100 marker is the most bullish price target on the street right now, and things are looking bullish. We thought 6,500 was going to be the price target, 6,600, 10%. No, we're seeing 7,000 and above. In fact, we have 4 strategists now above the 7,000 mark. But the question remains, will we actually hit that target? Let's hop on the charts and go see. Now, stocks were very, very ugly here today. We saw the S&P 500 fall, the Nasdaq 100 fall. The market is still open. It closes in a couple of minutes, by the way, guys. I'm just recording this a little bit earlier than usual. But the IWM, deep in the red. Same with the RSP. The Qs, a very red day for equities across the board. No index was safe. The big boys taking it on the chin, especially the Nasdaq 100. That has to do with some of the news that I mentioned earlier with regards to China. As a result of all of this, we did see volatility pick up in a very big way. VIX was up 10.82% today. Yields did gain ever so slightly. The 2-year yield, 10-year and 30-year yield. Dollar gained as well. Bonds fell as a result. And we did see some safe haven assets. Gold and silver were bought. Same with crude. And that actually had to do with a lot of what we saw in China. The stimulus coming. People are going to rotate into gold because of that. We also had some global political tension. Stuff I'm not really qualified to talk about. Stuff that happened in Syria. And then equities just pulling back as well. So we did see commodities and safe havens get a very, very nice bid. Gold and silver up nearly 1%, silver 2.64% respectively. But in the grand scheme of things, when you look at the S&P 500, there isn't really much that you can fault in this market. Yes, we had a red day, down 0.61% so far for the day, but not really a big deal. We've actually had like a 4% rally from the lows we made right here, pretty much to where we are right now. We're just seeing a bit of a give back here on some of the news events we saw here today, led by some of the bigger names, Nvidia, etc. Nonetheless, this is inconsequential, and even if we pull back all the way to the gamma flip, guys, I would still remain constructively bullish for us to go and take out the highs into year end. I think this type of selling you just want to view as a dip buying opportunity. Despite this candle looking very, very ugly, you can see this is a pretty bearish candle. We're right here at the lows of day. We do actually continue to move slightly lower into the session, but all in all, as long as we're above the gamma flip, you actually want to buy the dip that does come. That dip may be here, it may be there, doesn't really matter. You want to buy that dip because things are looking positive into the end of the year, into 2025. I really think material downside will come into mid-January. There's a lot of sentiment about people selling in January. I think that is going to be the contrarian trade. I don't think the sell-off is going to come in January. I'm thinking mid-Jan, early Feb. That's when we can see some real wobbling in the market. But until then, you want to remain constructively bullish. But what we're seeing right now is actually seasonally normal. Guys, in the month of December, it's only around the 14th or 15th where we sort of put in a higher low for December, and then we continue the move up into the end of the year, what we call the Santa rally, end of year rally, turn of the year rally. So even if we do pull back a couple of percentage points, like have equity markets here have been resilient, and we will snap back and retake all-time highs. We are in a seasonally bullish period. We don't want to fight trend, and if we do get to this gamma flip zone right here, buy that dip because we will be going higher into the end of the year. Very similar to the Nasdaq 100, guys. Yes, ugly candles, don't get me wrong, but you want to buy the dip if we do get to the gamma flip, or any dip we do get, because the end of year run is coming and you really do want to be a part of that. The RSP, actually one of the outperformers here today. All in all, it has actually pulled back pullback for the most part in the last week, where we have seen outperformance in the S&P 500, but it did outperform today, only down 0.41% versus 0.93% in the Nasdaq 100. The constructive price action you can see right here. I do think the equal weight's going to outperform this week, and we are starting to see the early innings of that. Outperformance isn't just to the upside, but also to the downside. And then looking at the RTY, really did hold in there, all things considered. I mean, it's at the gamma flip, actually consolidating right here, as you can see. Now, this is a very, very ugly candle at the lows of the day right now. Huge wick at the top. Don't really want to see that type of a candle. Nonetheless, we are still in positive gamma, and the bears just can't take us below right here. You can still see, yes, we are at the lows of the day, but we're sort of nearing the end of the trading day right here and finding support. So we'll see. I mean, if we do break the gamma flip, that does mean material downside for the IWM. But even if we were to pull back all the way to where the port is right now, this would still mark a higher low, assuming we hold above it, right? And then we can go from there. However, we are still in positive gamma, holding the gamma flip even after today's price action, right? We did see buying into the highs, and then we did see selling from those highs to where we are right now. So all in all, bears did win, but there was a lot of bullish price action that did occur. But all in all, when we look at the gamma zones, the gamma flip zone, the core resistance, and the put support, what we really do see is constructive price action for us to move higher in the IWM as well as the RSP. I don't have gamma charts for the RSP, but if we just draw a line here on a technical basis, this is probably where you want to buy for the RSP. We actually align it with the RTY being at the gamma flip. This is probably a good place to start buying in the Russell 2000 as well as the equal weight. Nasdaq 100, I think, is going to have a lot further more to pull back. I think we are going to pull back a little bit further here in the cap weighted indices. I think we are going to pull back in these cap weighted indices. And if you guys are looking for a little bit of alpha, look for gold. I think we see 3,000 gold for the end of the year, looking very attractive right here. 3,000 gold is like 400, 350 points. From this level indicates anywhere from 15 to 17% upside to that 3,000 target. So if you're looking for alpha, gold is probably the way to go. But then when you look at it, all things considered, if we get to Oppenheimer's price target of 7,100 at the end of 2025, that's also 17 upside from where we are. And what would you rather hold, gold or equities? Where equities have a dividend and a growth component, I'd always want to hold equities, in my personal opinion, but that's just me. I'm biased towards stocks over precious metals. Nonetheless, if you are looking for diversification and maybe a little bit of alpha, relatively speaking, look at gold, look at silver. I don't know what to think of Bitcoin just yet. We are seeing a little bit of consolidation. After a move like we just had, exactly what we should expect. I think we see some consolidation, and then we make the next move to 100,000 and above. Now, betting markets are pricing in about a 26% increase from where we are right now to the end of the year. Don't think that's going to happen, but Michael Saylor bought more Bitcoin today, and Bitcoin continues to remain an outperformer. Yes, we are seeing a pullback in risk assets, very ugly day across the equities, but it's not like we had this massive, huge pullback with every sector in the red. Market breadth continues to be robust, and this is just an opportunity for you to get long. This is actually the last opportunity, if the cap weighted indices are to pull back, that you will get before the end of the year Santa rally. So this is a blessing for those of you that missed this, because if we get to this gamma flip zone, you want to buy that because we will be going higher into the end of the year. The seasonal trend is with us up until January 20th, the inauguration. Then from there, we can talk about material downside. For now, buy the dip. And over the weekend, we got the S&P 500 rebalancing. This takes place on December 23rd. We had a couple of additions and deletions. Workday and Apollo Global Management will be added to the S&P 500. Corvo and Amentum Holdings will actually be removed. And you can see the S&P 400 and 600 additions and deletions as well. And looking at sentiment, guys, this is Goldman Sachs Sentiment Indicator, which measures stock positioning across retail, institutional, and foreign investors versus the last 12 months. Above zero and positioning is greater than what it was in the previous 12 months. Below the zero line and investor positioning is less extreme than what it was 12 months ago. And we are at this 2.5% region right here. It almost seems that the entire market is now very invested, pouring money in because we have the election certainty. Trump is in administration. He's very pro-business, pro-America, deregulation, tax cuts on the way, and participants from foreign investors to institutional investors want exposure, and that's why we're seeing sentiment positioning at extremes. You can also see this in the Russell 1000 growth versus value. Generally speaking, if this chart is rising, the 100 growth is outperforming. And that's exactly what we're seeing right now. Cyclicals outperforming defensives and the value area of the market. That really goes to show the risk on sentiment we're seeing right now. Still not the highs we saw here at the start of 2024. This largely had to do with the value trading sideways and growth trading upward. This is both value and growth are actually rallying. Growth is rallying more than value as it is right now. All in all, this is a risk on signal. We are in a risk on environment, and you want to hold risk into 2025. Now, the S&P 500 is pretty much trading at all-time highs. And what does that mean for returns, not just in the year and now, but in the very long term? And should you buy at all-time highs? This right here is what would happen if you purchase the S&P 500 on the highest close of each year from 1950 to 2024. Pretty much you would have invested around about 75,000 in this entire period. Starting in the very first year, you would have put 1,000 in. Your total investment here in 2024 would be 75,000, and in total the ending balance would be 3.5 million, not including dividends. Including dividends, you're looking at about a $5 million S&P 500 total value. So all in all, guys, regardless if stocks are at all-time highs, keep dollar cost averaging, and you want to hold risk, you want to hold equities, because at the end of the day, holding stocks is far less risky than just holding cash and doing nothing with your money at all. But let's jump back into the fundamentals. And guys, we need to start looking towards 2025 earnings and what we should really expect for the year ahead. In about 2 to 3 weeks, 2024 rolls over, and then it's onward and upward from here. Right now, the market's expecting about $275 in earnings per share. That would equate to about a 13% growth year over year from 2024. This obviously depends on what we're going to report. You can see that the actual EPS right now blended is $239. We still have Q4 earnings to report, so we'll see what that looks like. But you could say anywhere from 240 to 244, probably what we're going to report. 275 will represent about a 13-14% growth from where we are right now. Normally, we actually underperform these targets ever so slightly. Nonetheless, we are looking for growth in 2025. And when earnings are growing and margins are expanding, which they are set to do in 2025, guys, stocks do really, really well in that type of environment. So yes, stocks have come a long way. And yes, we probably won't have the same returns like we have in the last 2 years. But I think 2025, all things considered, if we actually get a substantial pullback and you buy that pullback, you'll do very, very well in the year ahead. But in the year and now, where does that leave us with valuation? And according to Morningstar, the S&P 500 is overvalued by about 6.6%. We've been that way for most of 2024, and only in these significant drawdowns did we ever see the index below its fair value. This isn't a true representation of individual. We can see that all of the large cap space is pretty much trading above their fair value, particularly large cap core and growth. 8.4% above fair value here in core, 13% in the large cap space. Mid cap growth actually trading above the large cap growth segment, but everywhere else in the market looks relatively attractive. Mid-cap core, mid-cap value, as well as the entire small cap space looking very, very attractive, relatively speaking. So there are parts of the market that are quite attractive, but on an earnings basis, the large cap space of the stock market, which is the majority of the stock market, does look fairly overvalued. Is it something to be concerned about? I don't think so. These are extremely high quality companies, and I think that the market is actually closer to fair value, especially in the large cap space when you adjust for factors like return on invested capital and return on equity. Nonetheless, Morningstar, this data is from Morningstar, see this as their valuation metrics and will take it as it is. Now let's actually talk about macro. We have both this GDP growth forecasts for 2024 to 2026. They expect stable global growth, but growth divergences to persist. Pretty much, we should see the US outperform most of the G20 countries like the Euro area, Japan, but we should see emerging markets, Asia, China, EMEA, and Latin America to grow GDP at roughly the same clip as the US. So the place to be when it comes to a developed world is probably the US. And if you're looking at emerging markets, probably China, especially with where valuations are right now. But the place to be definitely the US, and then the global growth, the global economy should grow at around about a 3% clip, all things considered. Now, looking at the US consumer, guys, and the household debt service ratio is still at very, very attractive levels, well below the historical average here, as you can see from the 80s all the way to like pretty much 2008. And from there, we have seen a decline and we have seen a sharp rebound here after COVID, but this is actually just normalization, nothing to really be concerned about. And we're sitting at, I think, household debt service very, very attractive. And that is despite the fact we've seen auto and credit card delinquencies rise quite significantly. So all in all, even though we have seen these rise, it's not really putting the stress on the consumer as a whole. And when you look at the actual consumer balance sheets, things look very, very healthy. Liabilities pale in comparison to total asset, where most of Americans have their assets in their home as well as other financial assets. This would be stuff like stock, maybe bonds. 17% of assets are held in pension funds, only 8% in deposits. So consumers have a lot of assets that they can access readily. They also have a lot of equity in their homes, most likely. There's a huge wealth effect, and this is part of the reason why the American economy has done so well. The consumer has quite the safety net to fall back on. And even when you look at the most recent jobs report, it came in better than expected. The unemployment rate did rise. However, when you look at a barometer for the economy, which is construction employment, it hit new cyclical highs at the NFP report. And this is telling us that the broad US economy is still really, really good. When construction employment starts to turn, that's when the economy turns. And we're seeing construction employment making new all-time cycle highs right here. This is not bearish. And then looking at data for the rest of the week, guys, we don't really have much on Tuesday, tomorrow, but on Wednesday, we have CPI, the headline and core figures, and Thursday, the PPI. We really want to see the core figure come in at 0.3 and the headline figure come in at 0.2. If we get those numbers, Bob's your uncle, we probably get our rate cut in December. If we get actual estimates above that, things can get a bit hairy with the inflation picture, but we'll take it as it comes and we'll discuss it more on the actual day of the release. Looking at earnings, so on Monday today, we just had Oracle, but then Tuesday, tomorrow, we really just have GameStop and AutoZone after the close and before the open. And on Wednesday, we have Adobe. And then Thursday, we have Costco and Broadcom. That's really it in terms of big names and then a couple of smaller names. But if you've made it up until here, thank you so much for watching. If you like this video, please subscribe, hit the notification bell, as well as the like button and leave a comment for the algorithm. Cheers.